We have an instant audit this morning from James Frischling, who's a co-founder and president of NewOak Capital. He's here with us in the studio. Cassano's been over in London, I believe, has been kind of the center of this investigation, you would think, for some time. What do you make of this, that maybe we'll get some criminal charges in the AIG case?
Well, I certainly think all interested parties are going to do everything they can to look into AIG.
Right.
It's become the poster child of kind of what went wrong. And in the same way that the only criminal charges, again, I think to date filed have been against the Bear Stearns hedge fund managers.
Yes.
They were the initial starting point. I think there's going to be a full investigation. And at the end of the day, if there's an email or a phone tape, if that's what they're looking for, certainly they're going to do everything they can to find something. Some
sort of smoking gun there. The question becomes for a lot of people who don't understand how, and quite frankly, maybe some of those people worked at AIG that didn't understand what was going on inside the company, that this was a small part of AIG that did a big part of its business and was able to drag down the company almost all by itself. There are other entities or other parts of AIG that have been operating very, very well. What's your understanding of what actually happened at AIG?
I mean, I think the issue of the case is whether this was fraud or whether this was poor judgment. And I think that makes it very difficult to go after. In terms of what happened, to state it somewhat simply, statistical models failed. So the idea that you could capture and you could monitor risk using a very analytical approach, a very rating-based approach,
right.
It failed. And as a result, one could argue it was poor decisions, or one could argue they were aware of the eroding, I guess, quality of the collateral, and therefore they knew something and did not actually report it to their superiors, their auditors, or their investors.
Okay, so key point. That'll be the question.
And that's the question.
Here, because it is possible, before we jump to any conclusions, people always want to say, oh, we need heads to roll, that they simply didn't know and that they didn't do their job well, but they didn't commit a crime.
And along those lines, there is so much blame. I mean, if you think about the borrower that took more money than he or she could pay back, did they know they couldn't pay it back, or did they make a bad judgment? Did the lender make a poor decision in lending the money, or did they know that this was someone that couldn't pay back? And in the case of AIG, did they insure products that they actually felt they could not pay on, or did they insure products that ultimately they felt were not worth nearly what they were telling their investors? So that is going to be the question.
All right, Jim, thanks a lot. James Frischling will be with us all morning from NewOak. We'll see how that AIG case turns out. In the meantime, President of James Gorman in for John Mack. Instant audit from James Frischling, co-founder and president of NewOak Capital. So John Mack's one of the big names that was surrounding this financial crisis on Wall Street, along with the leaders of Jimmy Kane at Bear Stearns and Dick Fold at Lehman Brothers and these CEOs that we had watched how they handled everything throughout the entire process. And now he's leaving too. What do you make of it?
Well, if I think of the financial or the investment banking business as a sports league, this is a very competitive space, and Morgan Stanley and John Mack are expected to win every year. And right. I think a heroic job was done distinguishing itself among some of its peer group and getting through 08. But this is a what have you done for me lately business, and they've lagged their #1 competitor in Goldman Sachs not insignificantly to start off this year. And I think that has a lot to do with this. Yeah,
Mack kept, to your point, kept Morgan alive at a time when it looked like for a few days. And I remember that I was outside the building and talking to people that were in there reporting on it at the time, that it looked like it was shaky for a while. It looked like Morgan might be the next to go. He was able to keep it alive, but you just don't think he was able to take the next step.
Well, I mean, I think his ability to secure that investment from Mitsubishi for $9 billion at the crux of this crisis was truly amazing, and a lot of credit should go, I think, to his success in navigating through this storm. However, he remained risk averse. Had the market continued to deteriorate, he would actually look like the sage, and maybe Mr. Blankfein over at Goldman might be in the different position.
Well, that's really the tale then, right? Morgan Stanley versus Goldman Sachs is that Morgan took on too much risk at a time when it maybe should have been cutting back. Firm nearly went under, saved it from that, but then as Goldman Sachs and maybe even J.P. Morgan were jumping in a little bit more at a time when the markets look very shaky, it's paid off for them. So.
And I think both those firms were on a relative basis, were in a better financial position to deploy capital and to take risk, especially J.P. Morgan. Morgan Stanley was a little bit lagging their two, I guess, top competitors, and as a result, I think stayed fairly risk averse.
You know anything about Gorman, by the way? He came from Merrill, right? And then went into to Morgan Stanley. He's much younger than John Mack. He's in his early 50s. But anything that we should know about him that you know?
I think, to your point, I think it is is a sign of maybe the direction Morgan Stanley wants to go right now in terms of wealth management, brokerage, fees for services, and a very client-driven business as opposed to an equity-driven business as opposed to bonds and proprietary and risk-taking with the firm's capital.
Because that's where John Mack comes from,
That's
the bond
correct.
business, right, over the years. Okay, Jim, thanks a lot. Let's get back over to Ashley now in London. All right, that was the Treasury Secretary Tim Geithner speaking up on Capitol Hill yesterday as he spoke about the economy, and we approached the one-year anniversary of the collapse of Lehman Brothers next week. President Obama is going to be here in New York on Monday, which will be marking the day that Lehman fell. And we'll talk about it now a little bit with James Frischling of NewOak Capital, who's here with us this morning. It's amazing that it's been a year, Jim, on a day, obviously, here. So this is 9/11, and we're remembering what happened 8 years ago in the city. But in terms of the financial industry and the country's economy, to be a year away from Lehman Brothers, what do you think? What goes through your mind as you think about what has happened over the last year?
Well, it has been truly an amazing year, and I think about how challenging things were a year ago, and almost how I don't want to say euphoric, because I am encouraged greatly by Treasury Secretary Geithner's comments and continued comments about how much more we have to go. But I will certainly say we've made a tremendous comeback.
We bounced back.
A tremendous comeback from where I really thought that we were on the brink of a far greater disaster.
Right, at the time. I mean, this goes back to Morgan Stanley. We were talking earlier about how John Mack has stepped down to the CEO, and at the time, it looked like it was going to go firm to firm. We were worried about Merrill Lynch. Then that Sunday, the day before the Lehman Brothers bankruptcy, they cut the deal with Bank of America, which got Merrill Lynch out of play, so to speak. We were worried about Morgan Stanley, got the money coming in from Mitsubishi. So it was going one to the other. Bear Stearns had started this off in March. But then it kind of stopped and stabilized at some point after a lot of government involvement. How has the government handled it? What's the grade?
Well, I'm actually going to give them a pretty good grade, and I'll even go to the. I'm not sure I'm going with an A-, but I'm certainly going with a strong B to B+.
They had to do what it was necessary, the involvement, the intervention, in your view.
That's correct. I think they took action. They took aggressive action. I think they were maybe, by their own admission, a little slow to get involved and maybe fully understand the depths of the problems.
Tell us why they had to act, because we had a conversation yesterday where somebody was making the point that I would have rather to see, this person was saying, I would rather see creative destruction take place and allow failure to happen so that the economy could have bounced back and we wouldn't have needed as much government involvement. That case has been made. A lot of people have made it over the last year. Why is it wrong?
It's a very fair argument. I think the problem with that is, and I think Mr. Bernanke is a great historian and knows just how troublesome the Great Depression was, maybe because of some inaction. And while there's an argument to be made that let the chips fall where they may, and let's build from there, I think the argument that having to invest in the banking system into some of the very institutions that helped create the problem and allowing compensation to remain in effect is very troubling. The fact remains, you could have gone to your bank machine and not gotten cash out.
So that was the fear,
and I think that would have
been worse, much worse if we didn't act rather than if we did act. Well, we did. Now we know, and now we're moving forward to see what happens next. So I guess the final thing is what's going to change as a result, because all the changes that maybe would have taken place as a result of the failure not only of Lehman Brothers but the problems in the financial system have not been implemented yet. Are we on the right track there? Is this Wall Street where you work is going to be a much different place a few years from now than it was last year, that it is now?
I think it's going to be different. I think you're going to see big government. I think you're going to see some major changes in the regulatory environment. And I think it's fair to say that we as an industry were not so successful at regulating ourselves. So it's going to be hard to argue against some of the changes that we're going to see put into place. And again, I think you're going to start to see these things rolled out. And I think you'll see a lot of things happen very quickly. I would anticipate by year end.
Right.
I think Obama's going to make some significant announcements, even starting on Monday. And I remember reading that he feels he was I guess, the only thing standing between the villagers taking pitchforks to Wall Street. And I think there's truth in that. And I think you're now going to see the regulatory environment change so that he can demonstrate he's doing what he said he would do.
All right. And then you'll know what the rules of the game are, and you have to, I guess, play by them, so to speak, right?
And you have to play by them.
All right, Jim, thanks. More from Jim in the next hour. Now.